Today, we are going to look at a moment from Warren Buffett's 1998 speech at the University of Florida. In that speech, Buffett talked about one of the most famous failures in financial history. A dream team made up of Nobel Prize winners, top PhDs, and hedge fund experts collapsed in just 4 years. Investors were wiped out. Most of the partners lost their personal fortunes too. This raises an important question. Why do smart people do stupid things?
The whole long-term capital management, and I hope most of you are familiar with it, but the whole story is really fascinating because if you take John Meriwether and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the 2 Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor that most of them had virtually all of their very substantial net worths in the business. So they had their own money up. Hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that to me is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says that it should be autobiographical, but
The hedge fund was called Long-Term Capital Management. The name sounded impressive, but reality went in the opposite direction. So why did these brilliant people fail so quickly and so completely? To answer that question, we first need to understand what they were doing. Their strategy was actually simple. They searched the market for 2 assets that were extremely similar. They bought the cheaper one, and they shorted the more expensive one. When the prices converged, they captured a small price difference, but the spread was very small, so the profit was also very small. To increase returns, they borrowed huge amounts of money. In other words, they used heavy leverage. The fund was founded in 1994. They ran this strategy for several years. Till 1997, the results were extraordinary. By the end of 1997, the partners' capital had reached about $1.4 billion. When things go well, everything feels right. 1997 was the peak of their business. It was also the peak of their reputation. 2 partners, Robert Merton and Myron Scholes, even won the Nobel Prize in economics. At that moment, it seemed everything was working. But when something reaches its peak, the reversal often begins. On August 17th, 1998, Russia suddenly defaulted on its debt. In simple terms, it refused to pay what it owed. Global bond markets fell into panic selling. The models that LTCM relied on stopped working. Losses began to explode. At the same time, their counterparties began pulling away. The financial structure LTCM had built collapsed like a row of dominoes. By the end of August, just days later, the fund had already lost more than 90%. Its positions were simply too large. So the Federal Reserve stepped in. Other institutions took control of the fund. The company did not collapse immediately, but in reality, its story was already over.
It's like getting hit by a truck. I can't imagine anyone wouldn't feel very deep emotions of loss, of why. And I'm no different from that.
Imagine experiencing that in middle age. A fall like that from heaven to hell must feel almost unreal. In October that year, Buffett happened to give a speech at the University of Florida, and he talked about long-term capital management. What he said next was very simple, but also very profound.
But to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum you want, but it doesn't do anything for me on the upside. And I think the downside's fairly clear. So I'm not interested in that kind of a game. And yet people do it financially and without thinking about it very much. There was a lousy book written once with a great title by Walter Gutman. The title was You Only Have to Get Rich Once. Now, that seems pretty fundamental, doesn't it?
Buffett did not focus on whether their strategy was clever. He did not explain how they should improve it. Instead, he pointed to a deeper problem. A problem of principle. You should never risk what you truly need for something you do not really need, no matter how large the reward looks, no matter how small the risk seems. There's a line you should never cross. Buffett summarized this idea with a simple phrase: only get rich once. This idea is one of the foundations of Buffett's philosophy. Many of his other ideas come from this principle. When you are poor, your main task is to become rich. But once you are rich, your main task changes. It is no longer to become richer. Your main task is simply this: do not become poor again. Of course, getting richer is nice, but it becomes a secondary goal. The primary goal is survival. If you understand that, you will understand Buffett's logic. Those 16 partners were already wealthy, but they wanted to become extremely wealthy. And in front of them was an opportunity that looked very attractive. The reward looked huge. The risk looked small. That kind of opportunity can pull you in. You feel tempted. You want to invest more and more money. You even feel that every day you wait is a lost opportunity. Most people think this way, but Buffett says that is exactly the mistake, because not becoming poor again is more important than becoming richer. No matter how attractive an opportunity appears, you should never bet your entire fortune. You should only invest money you can afford to lose. And if you manage other people's money, you should never use leverage. Yes, that means you will get rich more slowly, but that is fine. Slow is fine. The real goal is not speed. The real goal is survival. Buffett then gave a famous example. Imagine a gun with 1 million chambers. Only one chamber contains a bullet. How much money would someone need to pay you to pull the trigger? Some people might argue the probability is only 1 in a million. That sounds like free money, but that misses the real point. The real question is this: can you stick to your principles? A principle is something you never break. Not once. Not even when temptation appears. Most people cannot do this. When a big opportunity appears, they tell themselves, just this once. If I win this time, I will stop forever. But Buffett says that is self-deception. If you abandon your principle when temptation appears, then you never had a real principle. That is why you never pull the trigger. If you're the kind of person who breaks principles, sooner or later, a bullet will find you. If not this bullet, then the next one. That is how people eventually fail. Buffett's own life is a perfect example of this principle. His wealth did not grow quickly. Most people think he became rich early, but that is not true. About 99.8% of his wealth was earned after the age of 52. His son once said that when he was growing up, he did not even realize his father was wealthy.
People often think when they ask that question, well, Warren Buffett was this famous rich guy. He was not famous and he wasn't rich when we were growing up. I mean, he was in the process of making money.
Buffett spent decades investing without going backwards. That means his risk control was extremely strict. He never invests in businesses he does not understand. He never bets his entire fortune. He never uses leverage because his goal was simple: only get rich once. That means getting rich slowly, but never going backwards. In the long run, not going backwards is actually the fastest way forward. Compounding needs time, but once it starts, its power becomes enormous.
What difference if you've got $100 million at the start of the year and you're going to make 10% if you're unleveraged and 20% if you're leveraged 99 times out of 100? What difference does it make at the end of the year whether you've got 110 million or 120 million? Makes no difference at all. I mean, if you die at the end of the year, the guy that writes up the story may make a typo and he may say 110 even if he had 120, so you've got nothing at all. It makes absolutely no difference. It makes no difference to your family. It makes no difference to anything. And yet the downside, particularly managing other people's money, is not only losing all your money, but it's disgrace and humiliation and facing friends whose money you've lost and everything. I just can't imagine an equation that makes sense for. And yet 16 guys with very high IQs who are very decent people entered into that game. And, I think it's madness.
Buffett's example here adds another layer to the idea of getting rich once. If you are already wealthy, then becoming a little richer or a little less rich does not make that much difference. We can push this idea one step deeper. He sees life as a journey. And the purpose of wealth is to improve that journey. You should become wealthy because poverty makes life harder. But once you are wealthy, do not forget the purpose. Life is not a competition. You do not need to compare yourself to others. You do not need to prove anything to anyone, and you do not need to make others envy you. What matters is the journey itself. That is why Buffett said these people were chasing something they did not need because they were already wealthy. They should have used their freedom to enjoy life. Instead, they risked everything.
It's produced by an over-reliance, to some extent, on things. Those guys would tell me back when I was at Solomon, that a 6 sigma event wouldn't touch us, or a 7 sigma event. But they were wrong. I mean, their history does not tell you the probabilities of future financial things happening. And they had a great reliance on mathematics, and they felt that the beta of the stock told you something about the risk of the stock. It doesn't tell you a damn thing about the risk of the stock, in my view. And sigmas do not tell you about the risk of going broke, in my view, and maybe in their view now too. But I don't like to even use them as an example because they are. I mean, the same thing in a different way could happen to any of us probably, where we really have a blind spot about something that's crucial because we know a whole lot about something else. It's like Henry Kaufman said the other day, he said the people that are going broke in this situation are just two types, the ones who knew nothing and the ones that knew everything. And it's sad in a way.
Buffett's lecture is extremely insightful. Almost every point he makes is precise. The first question he raises is about history. How should we really look at history? People often say we should learn from history, and that events that happened before may happen again. That is often true. But here's another question. If something has never happened before, does that mean it will never happen? That is a much deeper question. Before Russia defaulted in 1998, it had come very close to default many times. Every few years, there would be a crisis. And each time, other countries or institutions stepped in to help. So Russia never actually defaulted. If you looked at history, you would conclude that someone would always step in, that the pattern would repeat. But in 1998, something different happened. No one stepped in, Russia defaulted, and something that had never happened before finally happened. Let me add another interesting sequel. After long-term capital collapsed, some of the partners were not ready to give up. They started another fund. This time they thought they had learned their lesson. They used the same models, but with lower leverage. They hoped to earn stable, long-term returns. But then the 2008 financial crisis came, and they faced a similar question again. Last time they had to judge whether Russia would default. This time they had to judge whether the US government would rescue Lehman Brothers. They placed a large bet again. Their reasoning seemed logical. In previous crises, the government had always stepped in, and just before that, the US government had already rescued Bear Stearns. So, from every angle, it seemed obvious. The government would rescue Lehman, but you already know what happened. Once again, something that had never happened before actually happened. The government let Lehman Brothers fail, and the fund collapsed again. History does have patterns, but history also evolves. Unexpected events can always appear, just like black swans. That is why Buffett says people often believe that rare events will not happen, or that something that never happened before will never happen, but that belief shows a lack of respect for reality. The world is far more complex than we think. Neither statistics nor mathematical models can fully capture it. Their limits are much larger than people assume. So we must recognize our own limits. Do not assume you understand everything, and do not overestimate your models. In this sense, Buffett's view is very balanced, and the conclusion he draws afterward is extremely sharp. Buffett once said there are two types of people who go bankrupt: those who know nothing, and those who think they know everything. In many ways, this explains why smart people do stupid things. They believe they understand everything, they lose their sense of humility, and eventually they cross a line they should never cross. There's another investor who often talks about a similar idea. His name is Duan Yongping. Duan is a Chinese entrepreneur and investor. He founded BBK and later became a well-known value investor. Both Buffett and Duan emphasize respect for reality. Duan talks about staying within proper boundaries. It means respecting the rules and not assuming you are smarter than everyone else. Buffett talks about never touching what you do not understand, never using leverage, never betting your entire fortune. Both men approach the world with humility. They accept their limitations, they focus on what they should do, and they avoid what they should not do. Perhaps that is the difference between cleverness and true wisdom. Clever people think they are exceptional, they overestimate their own abilities, and in the end, their cleverness leads them to foolish decisions. Truly wise people recognize their own limitations, they simply do what should be done. They know what they know, and they know what they do not know. That is why they go much further in the end.